Hey option traders, for today's trade we're looking at a bull put spread in oil giant Exxon Mobil. So taking a look at the stock on MarketSmith, Exxon Mobil is trading tightly above support at its 50-day moving average. Shares are also just 1% below a 114.76 buy point from a consolidation. XOM broke out on January 26th ahead of earnings, but shares have since struggled to hold above the entry. However, the stock has not undercut its 50-day line just yet, which means that this breakout is certainly not dead. Also, shares haven't triggered the 7 to 8% sell rule either. XOM is trying to hold above support as well at the 21-day line here. With declining earnings estimates and a sector rotation away from oil at this time, it's hard to consider buying the stock outright. But what if there was a way we could get bullish without having to buy the stock? This is where the bull put spread comes in. A bull put spread is a risk-defined way of getting long. It's one of the 4 basic vertical spreads that you can put on using options and involves selling one put and buying a lower strike put. The goal is for the stock price to stay above the higher strike to keep the full premium. If the stock price is below both strikes, then the maximum loss will be realized here. When it comes to options, we normally look at short-term trades, anywhere from 1 week to 1 month. But for this trade, we are looking at a longer-term bull put spread. Longer-term options tend to move a little slower than shorter-term trades, and that allows for more time to adjust or close, but it also means a lower annualized return. So with all of that said, let's take a look at my trading platform and set up a trade in Exxon Mobil.
So for this option trade, let's go to the option chain. And we are looking at the June 16th expiration. We want to be looking at put options. And for this trade, we are looking to buy the 95 strike. And then we'll add a leg where we're looking to sell the 100 strike.
Using the June 16th expiration, we can sell a 100 strike put and buy a 95 strike put to set up the bull put spread. In total, the spread will generate around $105 in premium with a maximum risk of $395. That represents a 26% return on risk between now and June. The maximum loss would occur if XOM closes below 95 on June 16th, which would see the premium seller lose $395 on the trade. The break-even point for this trade is $98.95, which is calculated as 100 minus the 105 option premium per contract. I would consider limiting the loss to the amount of premium received, which in this case would be 105. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Be sure to check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us for our regular options content where we discuss new trade ideas every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.